on the global economy. For those of you who attended last time's webinar, you'll be aware of the impact of COVID and what it did to the economy. Taking on from there, the response, as you may recollect, was that the Fed and the ECB and the central bankers adopted massive rate cuts and massive monetary stimulus to attack the problem. The extent of the rate cuts you can see from here, that at a level of around 200 basis points in December 2018, there's been a 177 basis points drop. So money is now extremely cheap and available as in a method and a bid to resuscitate the economy. The second aspect is the quantum of note printing that they did. The four central banks, the four big countries of the world, expanded their balance sheet by 29% of their GDP. So that's, again, as you can see, it's a massive, it's almost like the world is expanding it by a full 30%, right? So these two effects, right, were then supported by the government through form of a massive fiscal stimulus, which is directly impacting the economy, right? So that was also done in a very large and sizable manner of almost 4% of the world's GDP is being now thrown at this COVID crisis problem, right? And the nature of the support also that was given is mostly on the supply side, because the idea was the coronavirus had affected supply side, and if you attack that, then you can see a recovery in a much quicker time frame, right? So now, how is this post-COVID world shaping up as a result of these three efforts done by the bankers as well as the governments, right? So there are significant green shoots becoming visible all across the developed world. So the first is, if you look at the driving trends, right? So right up to end July, we have taken this, and as you can see, after the fall in terms of the lockdown, you're seeing now that gradually there is an uptrend. So clear V is forming in terms of the driving trends of self people and also those on transiting from city to city. Even there, as you can see, there is a V-shaped formation, right? And then when you come to the supply side, manufacturing is key. So you take a number of the US states, they all maintain their manufacturing indices. All of them, I hope you can clearly see the V-shaped recovery, right? And then when you go to consumer sentiment, based on the fact that these jobs have been protected, even that is showing a recovery. So clearly I'm showing you trends across the US and the developed world, which are showing a uptick in activity. So here are the restaurant bookings in Australia, Germany, Canada, and the United States, all showing a revival, right? And global scheduled flights. As you know, the airline sector is one of the most deeply affected by lockdowns. Sharp fall was seen, and gradually, yes, it's not yet a full V, it's just slowly rising up from a valley, right? And one of the ways to expect a V-shaped recovery is this data, I must tell you, is not about the current period. This data is about the previous crisis. The reason I brought out this slide is for a specific reason, that you can see that in the previous crisis, well before unemployment recovered, personal consumption expenditure recovered. Why I'm saying this is, unemployment is about the mass. So even if the lowest laborer is not getting his job, the people at the high end start consuming. So it doesn't mean that you have to wait for full employment to come through before consumption comes through. Very well before that, you can see a pickup. That's what, even at the bottom of the line, you can see higher incomes account for a larger share of consumptions, and hence you can expect a V-shaped recovery. And one of the final factors from an American market perspective is that during the global financial crisis, over 97% was the US household debt as a percentage of GDP. Today, that is only 74%. So it gives you enough headroom for people to use their credit cards, take short-term loans from the banks to go and consume whatever they want to consume. So all factors supportive of a V-shaped recovery. But let's drive our attention to China for some time. The reason I'm going to go to China is because China had the crisis first and also is posting the recovery first. So in a sense, they are a bellwether for world recovery. So in China, as you can see, there are a number of industry and services things, high frequency indicators like cement shipment, electricity production, property sales, auto sales, domestic flights. All of them, can you see, are posting a very sharp V-shaped recovery. So while China is not exactly the most popular country in the world today, the fact of the matter is that China is a kind of lead indicator of the world, because ultimately China exports a lot and what they are manufacturing is bought by people in other countries too. And this is the services sector. And as you can see from the green color, right, the number of services related indicators which are going to go back to pre-COVID levels is significant. Only one or two cinema halls are still at red. Otherwise, you see by the end of this year, you expect China to be fully normal. So as a result of this, the China's manufacturing and services PMI, again demonstrating a V-shaped recovery. And if you now look at the fact that as China showed it, a few months later, the US and Euro are also showing a V-shaped PMI. I have a little more detailed slide on the PMI here, where you can clearly see from a low of April how May, June, and July have seen a sharp bounce back in manufacturing in America. The same is true of Europe, right? And naturally, China has been taken the lead and is already at a 50 plus for close to 3 to 4 months. So clearly, all of this points out to the fact that the global economy is on track for a V-shaped recovery as opposed to U-shaped in earlier crisis. And the reason for that, I'm just repeating here, in terms of lockdown used as an infection containment, vaccine and a cure, you're seeing lots of good news coming from lots of places about how near they are to a vaccine and a cure. So all of those further support the thought process of a V-shaped recovery. And to summarize then, right, the rate action, the monetary stimulus, the fiscal stimulus are expected to result in a V-shaped recovery in the GDP, which, as you can see here, as far as the world is concerned, this year is a recessionary year of minus 4.9. Next year, world is expected to bounce back to 5.4. And since we just discussed the advanced economies, the fall was the sharpest there at 8% negative this year, but they are going to bounce back to about 4.8 next year. While emerging economies, the fall was less, but the rise is also going to be better, right? Now, within the developed countries, if you look at the various countries there, United States, Euro, Japan, UK, and Canada, as you can see there, all of them, this year, the Euro and the UK are both going to see double-digit negative. United States at 8%, and Japan is the least affected from a minus 6%. But next year, if you see, though Japan is least affected, its bounce back also is the least. Whereas those economies which fell 10% are going to actually recover by 6 to 6.3%, as the data here shows. The V-shaped delta tells you how significant is this minus to plus shift, because all of this ultimately feeds into the stock market and other market. So just while we cover the globe, let's not forget India and China. And in this emerging market world, as you can see there, China this year itself is not going to be in a recession. They are going to post a positive 1% GDP growth. And next year, they are going to be the fastest growing country in the world at 8.2%. So clearly, markets are eagerly watching China to see how this pans out. India is not far behind. We had a very sharp fall, but our rise is also expected to be sharper. We will cover India in a little bit of detail in a later thing. So just to demonstrate that all these data minus to plus actually looks like a V, I'll put the whole thing together in terms of the world, emerging economies, China, all in a graph to show you how a V is actually likely on the GDP situation. So one more indicator, and which is where I wanted to show you, is the Baltic Dry Index. This is the actual ground level thing which gives you confidence of a V-shaped recovery, because the Baltic Dry Index is nothing but the rate of booking a ship to transport oil, coal, car, any kind of goods. So the indicator tells you how the future trade is going to look like. So the very powerful indicator, and as you can see here, from a 1090 level in December, pre-COVID crisis, it fell to a low of 600, almost a 40% correction. And it's now back doubled. So there clearly the V forms for you. Just one caution that all this V-shaped recovery, right? The V forms, but whether the V sustains as a V or maybe transforms into a W or flattens and then rises is up for grabs. And I would draw your attention here to the 1 month. The 1 month indicator actually has fallen 25%, which means of late, there has been a resurgence of the virus in a lot of places and slight slowdown. So I would also say that while a V is clearly there, the timing of the V, right, you need to be a little more patient and wait for that to happen. So moving from the global economy to the global markets, we are seeing the gradual return of risk, right? So what is that? The story is that the flows are reversing, which went away from risk assets back into risk assets in some form. So what is the reason for this? The reason is that the money which went out of mutual funds and ETFs when the crisis hit, right, has reached a level of minus 1% of the total outflows as a percentage of market cap. Previous recessions tell us that this minus 1% appears to be a floor. From here, always a bounce back appears. And that's where we are. And that's one of the another strong reason why the markets are bouncing back, because history says that minus 1% appears to be a true bottom for the outflows from the stock market. At the same time, in all of that liquidity that was there, low interest rates, lots of balance sheet expansion by the Fed and the ECB, that money has gone and sat in cash funds, in money market funds, which are pretty much zero interest rate. So as you can see from this graph, there's $3.4 trillion of cash waiting to shift either into risk or back into safety as the time passes by. So our estimate is that out of this $3.4 trillion, close to $2 trillion is got the potential to move into equities. Hence, equities should be showing a rise, which is what I want to show you. But first, because I told you that the Baltic index is showing a little bit of a correction, so you can see that gold continues to hold its charm, right? The safe haven, right? While from March to August, it has gone up 15%. Right, so clearly money is still following gold because there is still uncertainty on how long this recovery will take. But money which was going into the fixed income, US 10-year, is now started going out, which is a positive 0.54 positive return that you're seeing, means that money is going out of fixed income. That's why interest rates are rising. So that's one indicator there that I would like you to take a look at. And now when we move to equities, you can clearly see the V-shaped recovery, right? In March, you had the Dow 1-year return at minus 14%. The Nasdaq was flat at 0.6 and the S&P at minus 7. Today, you can see the change from minus 14 to plus 0.7, from 0.6 to 36.2. So on the right-hand side, the last column gives you the extent of the move. So clearly, the V-shaped economic recovery, the markets are discounting it with a V-shaped stock market recovery, right? So at the same time, emerging markets, which are the riskier than the US or developed markets, are still showing by and large an outflow, which means the American consumer, the developed market consumer who invests in ETFs, who invests in these, is still a little bit wary of taking that risk. So you're seeing that barring our country, India, and to some extent Taiwan, the rest of them have seen sharp outflows continuing in this year. So at this point in time, I'd like to show you that just because FII money is going out, right, it does not mean that those markets are not recovering, because there are local participants who are buying. So the emerging countries are also showing a V-shaped recovery is evidence from the fact that despite FII flows not being so strong, there are still V-shaped recoveries in the emerging market. Overall, MSCI emerging market has turned around to 28%, China by 28%, and India and South Korea by 30% plus. That's the change in the 1-year return. Yes, Singapore is not having a good time, and Hong Kong, you know, is going through its troubles. But overall, the scenario of the world is of a V-shaped recovery in the economy, driving a V-shaped return to risk in terms of the asset class.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.